If you're a government employee and you're getting close to leaving, here's something important that most members don't prepare you for. Right? Your pension payout could be delayed. Now, think about what that really means for you. You've given years, maybe even decades to your work, and you're expecting that final step that you take away to be a breeze, right? You get access to your money, but instead you're left waiting, sometimes for months, sometimes could go up to a year before you even see a cent of your money. And this is why saving before your exit is not just a nice to have, but absolutely critical. Now, today's video, I'm going to be sharing with you the story about Susan, a government employee who reached out to me. She had planned to exit very, very carefully, but when it came to her pension payout and she experienced a delay, she suddenly found herself highly stressed, right? Because she had to cover a significant number of bills. And for the first time in her life, she felt out of control from a financial perspective. Now, today's video, I'm going to be sharing with you 5 practical tips that you can use to avoid the situation that Susan found herself in. But beyond that, I want to be able to provide you with something that gives you the difference and helps you to have peace of mind, takes away from the unnecessary stress that you would have for your exit. Now, we're covering 5 steps. So the first of the 5 that I want to share with you is start the planning early. Now, I used to say start your planning around 3 months earlier, especially if you're reaching out to me, start 3 to 6 months a bit earlier. However, from your side, aim to start the planning 12 months earlier. So even if you engage with me 12 months earlier, it's a good idea to start that from that perspective, because you can then start to look at, hey, how do you now start saving money aside, right? How do you start to understand exactly what the process is? Of course, you want to first make that critical decision of, are you going to be retiring or resigning, which route that you're heading toward. That's going to be your first decision. And it's not a decision that's easy to make because there's so many factors to work through. Now, when you start the consultations a bit earlier, it gives you a chance to work through the system. It gives you a chance to understand exactly what's happening without you going through a bit of a rush. Once you make your decision on which route that you're taking, whether you're retiring or resigning, you then can start to look at, hey, now that you know it's a retirement or it's a resignation, how can you make sure that it's the best retirement possible? How can you make sure that it's the best resignation possible? Right? How can we make sure that we avoid payment delays? And what you could look at doing is reaching out to your HR, getting access to simple things, getting access to the paperwork, getting access to whatever documents that's needed. If you need to do bank verifications, you have those things done. And try and see if you can submit your paperwork a bit early. Say you submit your paperwork a month earlier or 2 months or 3 months earlier. Then it's in the system, it's getting processed. Whilst you're at work, you can track to see exactly what's taking place. If there's a document that's missing, you can supply the document in quickly. If HR requires something from you, you at work, you can provide the information quickly. You're able to track the progress of what's happening in your application. Compared to what I see most members doing is the application gets submitted the last day of the month that they're working. So it's the last day of the month, then they leave, and then HR says they need some documents. It becomes difficult. Communication breaks down. If the pension fund requires a document that wasn't there, or somehow a document gets misplaced. So every single hiccup that happens becomes incredibly stressful because now you're not expecting that to happen, right? Whereas when we start to do the planning a bit earlier, we can weather the storm because it happens, things would happen. And at that time that you're expecting your money to happen quickly, this is where there might be unexpected delays. And you just want to prepare yourself mentally for that. So starting to plan a bit earlier is the first thing that I want to share with you. Second thing is, how do we end up saving money? Now, one of the easiest ways that you can do this, obviously first, let me explain why do we want to save money, is we need to have a backup plan. Keep in mind that whether it's retiring or resignation, your money might not flow immediately to you. The pension fund, if you're leaving now, the pension fund may not pay you out tomorrow, or they may not pay you the day after, right? There might be a process. So in that time, you need to make sure that you've got some money saved up, because then it allows you to tide yourself over, right? You can keep up with debit orders, you can keep up with your utility bills, whatever it is that you need, and you don't feel stuck or frustrated, especially if any hiccups come in, right? Because you know you have money kept aside. I'll go into more details just now, but how do we save money? Simple. The simplest way that I've been guiding members to save money is we take the birthday bonus. So if you look at your birthday bonus, it's double money that's getting paid. Now, and this is why it's nice to start 12 months earlier, because you know for sure you had a birthday in between. So once you receive your birthday bonus, take those funds and immediately save it, keep it aside, right? Because then you know it's a large sum of money that you can set aside. Right? It's double your salary, right, that you're getting for that month. So you know, hey, that's 1 month's salary that can carry you over for a month. Or if you can curb your expenses, it carries you over for a month and a half or 2 months, depending on how you manage your finance. But easy trick is to make use of the birthday bonus. Now, the second thing is, where do we save this money? So once we have access to the money, where do we save? Now, I have had members reach out, and there are YouTube videos where I've explained it. We could use investments, we could use investment companies, we could use the insurance products for savings, things like endowments, we could use the bank product. We could keep this money at home, put it under your mattress, right? Now, the best, safest way that I would recommend for this would be a bank product. I know it seems very, very weird because I should be guiding you towards investments or a product from the investment company side, but we have to understand the nature of that money, right? When we are using investment companies, typically we are looking for long-term investment. Sometimes there might be an element of risk in it. Whereas if you keep your money in your bank account, you know that, hey, it's stable. You're earning interest inside of your bank account if it's a savings account or a notice account or a fixed deposit. But you want a place where it's easy access, and you don't want to be concerned about the markets, because keep in mind that at the time that you leave, you need to be able to access that money to cover debit orders, things like that. So that's the third thing I want to share with you. Fourth point is you want to revisit all your expenses. Now, at the time that you leave, right, retire or resign, it's also a major transition. So a lot's going to be taking place. So then you want to revisit your expenses. But I would do this for you again when we connect. Let's say I'm assisting you with the planning. I would do this for you anyways, part of the journey. But if you could do this on your own before you actually leave, again, this is why starting a few months earlier becomes critically important. But you're revisiting to have a look at your expenses. Hey, you know what? You have certain expenses right now. And a simple example that I can give you is take something like disability cover, right? Maybe in your life cover insurance, you needed disability at that point in time, but things have changed so much now. At that point in time, you needed disability, but now maybe your bond is paid off, or maybe you don't need so much of cover, you see? Or now the fact that you are going to be stopping work, it's not so much risk anymore. So then or it could be, hey, disability cover usually has a cutoff date, so it's going to be expiring anyways. So then you want to revisit all of your expenses to see, hey, look, what can I cut down? What's not necessary anymore, right? What do I really need, and what's a want? Now, this doesn't mean you're going to cut out anything, but get your mind trained to thinking about this a little early on, as opposed to just at the time that you leave and then you started to shuffle to see how do you adjust your expenses accordingly. And fifth point that I want to share with you is aim for a target in terms of what you should have kept aside, right? Now, let's call it as it's commonly called an emergency fund, but let's call it a get out of problems fund, right? Because ideally that's what it is, right? It's your peace of mind fund. It's at the time that you are exiting. The pension fund takes 1 month, 2 months, 3 months, and you need an income for that time. This is where we need the peace of mind fund to kick in, because you need to be able to access it. This is why, again, I said saving in a bank. So how many months do we want to save? Ideally, we want to save 3 to 6 months. Ideally, 3 to 6 months of your expenses in that fund, simply because we don't know what might take place, right? We don't know the time that you are exiting. If you are exiting towards the end of the year, let's say you're leaving in November, then keep in mind that in a December period, the fund might have a lot of people that are going on leave. And as a result, the processing might be a bit slower than how it would normally be, right? Even in January, not everybody's returning at the same time, might be a bit of skeleton staff. So processing takes a bit of time. So understand that might change the dynamics for you, right? Or let's say you are leaving just before a formula change, or there's some big regulation that takes place, like when we had the two-part system, and a lot of people were leaving. So if you're leaving at a time where there's a huge influx of members that are leaving at the same time, then naturally the fund could become bottlenecked, and in which case it's difficult for them to be processing applications, to keeping up with SLAs. So then you want to be mindful, hey, look, we have money kept aside. So 3 to 6 months, I feel, is sufficient. And I haven't had any members needing more liquidity than that. And again, this allows you to tide yourself over, even when money gets paid over to you. Right now, I've observed this for members who are resigning, especially when we are doing the planning. What I've noticed is sometimes we need a bit more time with the tax planning, right? I may, I'm a bit OCD when it comes to the taxes. I want to look to see how can I get to zero, right? How do I make sure that the tax comes to zero? sometimes it might work on the first calculation for me, but usually I've got to do multiple calculations, right, in order for that to happen. Or I might be looking at saving tax on your lump sum, but then I want to look at, hey, how do I save tax on the income? So then I'm working various calculations. And when we're doing it like that, we then need a bit of extra time. Now, again, if you have access to some savings, 3 to 6 months of money that's kept aside, gives us some breathing space to be able to run the calculations because we know you're not in a hurry and we don't rush any of the planning, right? Or, well, in any event, we don't rush, but that makes it a bit tough for you when whilst we're doing planning and you wondering, hey, what's happening? Why is it taking so long? Because keep in mind, for most things, we're only going to have one chance to make that right. And if we make a mistake, then you're going to end up losing a significant amount of money, or we don't have the optimal results. So understand that, hey, there's going to be some delays. It might not run smoothly, but look to see the things that you can control, right? You can't control the pension fund in terms of how they are operating. You can't control the investment companies, or you can't control SARS for the tax procedures. You see, all these things would have to run its course. But what you can control is starting to plan a bit earlier, making sure that you're getting good advice, having some money set aside. And once you do those things, you just ease nicely into the process, right? It doesn't become this hectic, stressful situation that, very often we see government employees putting themselves in. I hope the video has been helpful. Give me a thumbs up if it has, and comment below. Let me know from the points that I shared with you today, which of those stand out to you the most, right? How would you use that in terms of your planning? And remember to share the videos amongst your friends and colleagues so that they too can be empowered to make better decisions. And I'll catch you in the next one.